For our last topic in Chapter 5, we talk about the classified balance sheet. Now, if you remember in Chapter 2, when we first learned about financial statements, we said there were 4 financial statements: the income statement, statement of retained earnings, the balance sheet, and the statement of cash flows. We focused on the first 3 statements. We're touching on the balance sheet again. So as a reminder, the balance sheet has your assets, liabilities, and equity. Right? And we said, of course, assets have to equal the sum of your liabilities and owner's equity. And we learned a nice, concise format that illustrates that. In this chapter, we learn about a format that places those items into different categories. So those categories are, we still have our assets. We now divide our assets into current assets and non-current assets or long-term assets. We further subdivide the non-current asset section into 3 additional categories. The first one is plant, property, and equipment. The second is long-term investments. These are financial investments in other companies like stocks or bonds. Long-term investments. And then lastly, intangible assets. Intangible assets, those also bring a future benefit to the company, but they're ones that do not have any type of physical forms. So think of like copyrights, trademarks, things like that, right? They bring the company exclusive rights, but it's something that's difficult to see, to touch. All right, so how do we know if an asset is current versus non-current? You're going to use the 1-year mark as your guideline. So if it's an asset that you expect to use up or collect within 1 year or less time, you classify it as a current asset. Our common examples include cash, accounts receivable, supplies, and other prepaid items. Non-current assets, that's anything the company is going to use up in more than a year, use or last more than a year. We're mostly out of these 3 categories here. We're most on plant, property, and equipment. That's what we've seen examples of so far, right? Equipment, machines, furniture, things like that falls in that first category, and we calculate depreciation on it. Those are your different categories of assets. All right, so moving on to liabilities on the balance sheet. All right, so your categories for liabilities are similar to assets. You have current, also called short-term, and non-current, also called long-term. A benchmark of 1 year or less classifies that item as a current liability. Common examples are accounts payable, interest payable, salaries payable, and unearned revenue, an account we were introduced to in Chapter 3. All right, non-current liabilities, anything that is going to come due in 1 year or more than 1 year's time. Examples are notes payable, loans. Those are your more common ones. All right, and then we move on to equity. Equity doesn't change. It's still made up of the 2 items as before, common stock and retained earnings. So the classifications, those new classifications, only apply to assets and liabilities. And those 2 categories are current and non-current. It's just that we further divide the non-current category into plant, property, and equipment, long-term investments, and intangible assets under your assets section on the balance sheet. Here's an example of what a classified balance sheet would look like. Here's the assets section of a classified balance sheet. Notice in the title, we don't have to say classified balance sheet. We know just by looking at the different categories, whether it's the classified format or not. Okay, so you can see there, current assets, still in order of liquidity with cash coming first. Long-term investments comes next if it applies to the company. Like I said, in this class, we're probably not going to really have long-term investments or intangible assets. Mostly it'll just be the plant, property, and equipment. But I just wanted you to get an idea of what it would look like if we did have it. And then focusing on that PP&E section, you'll see that new account that we have, accumulated depreciation, a contra asset account. Right? We subtract that from equipment and we will get what's called the net book value. Right, there's your total assets. Let's move on to the liabilities and equity section. Here it is for the same company. Current liabilities, this particular company didn't have any non-current. So if they don't have that category, you don't have to show it. Okay, accounts payable, salaries, and unearned revenue, very common examples of current liabilities. And then stockholders' equity, those same two items that you had in chapter 2, right? Common stock, retained earnings. And your total assets equals the sum of your liabilities and equity, 120 to 120. There you go. There's your classified balance sheet. Go ahead and try that practice exercise just to make sure you can properly categorize different items in the right balance sheet classification.